AI competition is shifting from a contest over technology and chips to a contest over the ability to organize capital. What now constrains AI expansion is no longer simply whether there are enough chips, but who can mobilize sufficient capital and organize chips, electricity, land, data centers, and customer demand into a commercial system that can operate sustainably over the long term. Nvidia's partnership with Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR, which aims to mobilize more than $500 billion of third-party capital for AI infrastructure, is the clearest signal of this change. It means that Wall Street is beginning to package GPUs, data centers, and compute contracts as a new type of infrastructure asset that can be financed, generate cash flow, and be allocated to institutional investors. Nvidia provides the technology platform. Institutions such as Blackstone organize the capital, and AI labs and cloud computing companies lease compute capacity, then use future compute revenue to repay the financing. In other words, Wall Street is converting future AI demand into infrastructure orders today. This capital transmission chain could benefit 4 companies at the same time: Nvidia, Microsoft, Micron, and Blackstone. However, they would benefit in entirely different ways, and the conditions required for those benefits to materialize are also different. Let us start with Nvidia. Nvidia is the most direct beneficiary in this chain. The problem in the past was that customers wanted to buy GPUs, but might not have had sufficiently strong balance sheets. This was especially true for some emerging AI labs and AI cloud companies. They had demand, but unlike Microsoft, Google, and Amazon, they could not fund tens of billions of dollars in capital expenditure solely through operating cash flow. Once third-party capital is introduced, customers gain greater financing capacity, allowing more data center projects to begin construction and giving potential demand a genuine chance to turn into orders for GPUs, networking equipment, and software. Therefore, what Nvidia is really doing is not simply selling chips, it is helping customers solve the question of who will pay. Nvidia can therefore serve as a core investment target for exposure to AI capital organizing capability, but the variables that truly need to be monitored are the amount of financing actually deployed, incremental GPU orders, compute utilization rates, and how much risk Nvidia is actually assuming. NVDA has the strongest technical setup among the 4 stocks. Since rebounding from its August 5th low near $196, NVDA has moved decisively above the area where its moving averages had converged, indicating that the market is absorbing short-term profit-taking. The price is only about 8% below its previous high of $236, placing it in a consolidation phase ahead of a potential breakout. As long as it does not fall below $208, the medium-term upward structure remains intact. The current price of $218 is at a short-term high, so chasing the stock is not recommended. There are 2 better entry points. 1. Enter on a pullback to $208 to $210, with a stop loss at $203. Or 2. Follow the breakout after the stock moves above $236 on strong volume, with a stop loss at $220. A drop below $200 would invalidate the bullish structure. The second company is Microsoft. Microsoft is not a direct participant in Nvidia's financing partnership, but it could become a major beneficiary of the financialization of AI infrastructure. Once AI infrastructure becomes a financeable asset, it effectively means that Wall Street is beginning to recognize a key idea. Compute is not merely a cost, it can also be infrastructure capable of generating recurring revenue. For Microsoft, this matters because it has Azure customers, enterprise software distribution channels, cloud computing cash flow, and a large number of data centers that can switch between AI and traditional cloud workloads. Compared with companies that own only GPUs or data center facilities, Microsoft has a complete closed loop of demand. Microsoft's advantage is its relatively balanced risk-reward profile. If Azure continues to grow, free cash flow improves, and AI revenue begins to catch up with capital expenditure, Microsoft would look more like a medium-term allocation target within the AI capital cycle. Moreover, MSFT has the clearest technical structure and the strongest trend among the 4 stocks. Since gapping sharply higher after its July 30th earnings report, the stock has surged from around $410 to $506, a gain of approximately 23%. Its moving average system is in a perfect bullish alignment, with the price trading above every moving average. This is a textbook strong uptrend, with no bearish technical signals. The only point that requires attention is short-term momentum indicators such as the RSI may have entered overbought territory, creating the potential for a technical pullback. At the current price of $506, the stock is only about 2% above its 5-day moving average and about 8% above its 10-day moving average. Aggressive momentum traders can establish a position near $506 with a stop loss at $480. More conservative investors can wait for a pullback to $485 to $497 between the 5-day and 10-day moving averages before entering. If the stock breaks directly above $520 on strong volume, traders can follow the breakout with a stop loss at $500. The third company is Micron. Micron may have the greatest earnings leverage in this value chain, but it also carries the highest risk. The bottleneck in AI infrastructure is now extending beyond conventional GPU production to HBM, or high bandwidth memory. Three conditions must be met for the bullish case for Micron to hold. First, the increase in the number of GPUs shipped by Nvidia must exceed the decline in HBM capacity per GPU. Second, HBM pricing in Micron's market share must remain strong and must not be significantly eroded by SK Hynix or Samsung. Third, capacity expansion must not proceed too quickly. If the entire industry adds capacity on a large scale in response to high profits, the memory industry could still return to its traditional cycle of oversupply and falling prices. Micron is therefore better suited as a high beta tactical position. MU is currently forming a base after a deep correction. It has fallen approximately 31% from a high of $1,255 to its current price of $861. The stock is finding slight support just above its 10-day moving average, but it remains constrained by resistance from both the 5-day and 30-day moving averages. This is a typical rebound resistance retest structure. Momentum indicators such as the MACD should be monitored for a potential bullish divergence at the lows. The current price of $861 sits near the middle of the range, offering only an average risk-reward profile. There are two better entry points. 1. Build a position in stages on a pullback to $820 to $840. Or 2. Follow the move after a breakout above $925 on strong volume. Chasing the stock in the $860 to $880 range is not recommended. A drop below $780 would invalidate the basing structure. The fourth company is Blackstone, which provides precisely this capital organizing capability. Blackstone's potential returns come from management fees, private credit interest, project investment gains, and the eventual exit and securitization of AI infrastructure assets. This is also the most important change to watch as AI competition enters the capital phase. Blackstone's advantage is its ability to mobilize third-party capital from sources such as insurers, pension funds, and sovereign wealth funds. As long as its AI infrastructure assets under management expand, Blackstone has the opportunity to earn management fee revenue for years. The investment thesis for BX is therefore not a short-term surge in AI orders, but the gradual emergence of AI infrastructure as a new growth category within alternative asset management. It is better suited as a medium to long-term proxy for the financialization of AI than as a vehicle for trading short-term price sensitivity, as Micron is. Technically, BX is testing the $141 to $145 resistance zone. If it breaks through, the target range is $150 to $160. Short-term support lies near the 5-day moving average. Chasing the stock at its current level is not recommended. Waiting for a pullback to $137 to $138 before entering would be more prudent. If the stock breaks directly above $146 on strong volume, traders can follow the breakout with a stop loss at $138. A drop below $126 would weaken the medium-term trend. Taken together, these four companies reveal a complete AI capital chain. Blackstone organizes the capital. Nvidia converts that capital into a compute platform. Micron supplies the critical memory constrained by limited supply. And Microsoft then converts compute into revenue through Azure and its enterprise customers. If the capital is deployed, orders grow, and utilization rates remain high, the sequence of benefits could be as follows. Nvidia receives the most direct orders. Micron gains the greatest earnings leverage. Microsoft secures relatively stable cloud revenue and valuation recovery. And Blackstone earns long-term management fees and credit returns. The true dividing line in this round of AI competition is therefore who can turn capital into compute, and then turn compute into sustainable cash flow. Technology determines whether a company can enter the AI race. Chips determine whether it can scale. And the ability to organize capital ultimately determines how far it can go in that race.